Welcome to the Stock Market Palantir. Today we are going to talk about Ovid Therapeutics. It presents one of the most intellectually compelling and, frankly, frustrating valuation puzzles in the small-cap biotech space right now. We have a situation where the company secured a massive $175 million PIPE financing, a truly significant capital infusion, which extends its cash runway well into the second half of 2028. At the same time, they released fundamentally de-risking phase 1 clinical data for their lead asset, OV329. And yet, despite this double positive, the market cap is hovering dangerously close to its cash value, which is sitting around $95 million.
Right, and that extraordinary paradox is precisely what brings us here today. The central question we're facing is whether this deeply suppressed valuation is simply a temporary technical inefficiency. A bit of structural noise that the fundamental value will eventually overpower, or if the sheer complexity of the resulting market microstructure, driven mainly by warrant mechanics and then combined with regulatory risks, fundamentally negates the clinical value you've just described.
My position is, well, it's pretty clear. Ovid is currently priced for liquidation, while at the same time management is fully funded and actively executing on a multi-year registration and pipeline campaign. I'm anchoring my perspective on the science and that institutional commitment, and I view the current technical pressure as just temporary friction that's masking profound intrinsic value.
And I'm coming at it from a different angle. I maintain that the volatility induced by the Series A and B warrant mechanics, the high off-exchange trading that resulted, and the very real threat of an aggressive reverse stock split, they present an immediate structural ceiling on the price. For now, true price discovery based on that promising clinical value is, I think, structurally blocked, making the stock highly risky for fundamental long-term investors.
The defining factor for me is the clinical asset, OV329, and that secured capital runway. I see why you think that the stock structure is overwhelming the science, but let me give you a different perspective, one that's rooted in the drug's actual mechanism. So OV329 is a highly potent GABA-ANT inhibitor. Historically, this entire drug class has been crippled by the catastrophic safety liability of permanent vision loss, medically known as concentric visual field constriction, basically irreversible tunnel vision, caused by the predecessor drug vigatatrin.
The black box warning, yes.
Exactly. The phase 1 trial for OV329 provided the critical linchpin here. Comprehensive ophthalmic evaluations, including things like OCT imaging and perimetry, showed no treatment-related ocular changes. And this was across 68 healthy volunteers, even at therapeutically relevant doses. This finding, it potentially achieves the holy grail for this mechanism, decoupling high efficacy from that catastrophic safety liability. And what's more, the sheer presence of Tier 1 institutional investors like RA Capital and Janus Henderson in that $175 million PIPE validates that, sophisticated institutional due diligence agrees with this de-risked profile. The market is assigning an enterprise value, an EV, of nearly zero, completely ignoring the scientific breakthrough and the rest of the diversified pipeline.
I absolutely agree that the institutional validation of the science is a major point of comfort. I do. However, that institutional validation of the science, it didn't magically solve the immediate stock price problem. My primary concern remains the capital structure. The Series A and B warrants attached to that PIPE created what is essentially a severe technical overhang that suppresses the share price, and it does it immediately and mechanically. I'm sorry, but I just don't buy that the stock will appreciate fundamentally right now, regardless of the pipeline's promise. Let me tell you why. The immediate stock suppression we're talking about stems directly from the practice of delta hedging. And just to clarify for everyone listening, when we say delta hedging, we mean that the institutional investors who got those warrants, they are obligated to short sell the common stock to neutralize the price sensitivity of the derivative, the warrant, that they just purchased. It is a mathematical market-neutral strategy, but the constant flow of that hedging short volume acts as a persistent wet blanket on any attempted price appreciation. This pressure is amplified by the sheer size of the PIPE relative to Ovid's existing market cap. And on top of that, we can't ignore the regulatory pressure.
The NASDAQ-compliant situation, driven by the price being under the $1 minimum bid, is a very real sword of Damocles. Now, they have until February 2026, but the mere authorization for a 1-for-1 up to a 1-for-40 reverse stock split is a massive psychological barrier. The price action today is dictated by mathematical arbitrage flows, not positive clinical news flow.
Okay, let's delve deeper into that idea of structural suppression, particularly the microstructure data you mentioned about short volume. You're pointing to the exceptionally high reliance on off-exchange execution, with the short volume ratio peaking at over 66% in late 2025 as proof of structural suppression that prevents a price breakout.
I think it's compelling proof, yeah. When 2/3 of the trading activity in a stock is routed away from the lit exchange and categorized as short volume, it confirms that liquidity is being dominated by activities designed to push or just keep the price anchored. Whether that's complex arbitrage or institutional selling, the result is suppression.
I would challenge that surface-level interpretation of the dark pool data. That volume, peaking at 66%, is indeed high, I'll give you that. But its meaning in the context of a fresh warrant issuance is, well, it's frequently misunderstood. Upon closer inspection, that off-exchange short volume reflects two specific, critically non-bearish dynamics that I think support my view of temporary technical noise. First, you have market maker internalization. When we see high dark pool short volume, it's often just a wholesaler immediately selling short to fulfill large batches of retail buy orders. They are shorting purely to facilitate demand and provide liquidity. It's a supply mechanism, not a bet against the company.
But that mechanism still adds downward pressure, even if the motive isn't malice.
It adds volume, yes, but not fundamental bearish conviction. And more importantly, we have to consider the hedging mechanics related to the warrants. You mentioned the Series A and B warrants. Are you considering the staggered maturity and strike resets associated with these instruments? The need for delta hedging isn't constant. It fluctuates based on price, time to expiration, and potential reset clauses. This means the suppression is inherently time-limited and mechanistic. Once the hedging requirements stabilize or those short positions are covered, that technical anchor is lifted, and that allows the fundamentals, the science, to take over.
That's a compelling argument regarding the mechanism, and I'll concede the flow is mathematical, not necessarily rooted in a fundamental distrust of OV329. But have you considered that regardless of the hedging motive, be it market-neutral arbitrage or simple liquidity provision, the immediate outcome for the existing fundamental shareholder is, well, it's unequivocally negative. The stock remains anchored near or below the deal price, denying the fundamental thesis the relief rally it desperately needs after securing such substantial funding and positive Phase 1 data. The technical reality overrides the fundamental promise, at least for the time being. Investors buying today are betting purely on an eventual structural resolution, not on immediate scientific appreciation.
Which brings us squarely to the significance of the scientific proposition itself. Let's talk about the de-risking of OV329. You agree the Phase 1 data is positive, but I stress that achieving the separation of that GABA-AT inhibition efficacy from the irreversible visual constriction liability is a breakthrough. This means Ovid could address a massive unmet need in refractory epilepsy with a validated mechanism, but without the baggage of its predecessors. The valuation disparity, just look at the sell-side consensus. The average analyst price target sits at $4.23 compared to the current $1.22 price. That reflects a massive, quantifiable mispricing based purely on the scientific reality. We are effectively purchasing a Phase 2 ready asset with a proven safety profile in its key problematic area at an enterprise value near zero.
Outcome for this mechanism. However, I'm not convinced by that line of reasoning because we must be realistic about the stage of development. Biotech valuations are defined by risk. That Phase 1 data, while promising, is still in healthy subjects. The efficacy and, more importantly, the long-term safety profile must still hold up in larger, longer Phase 2 and Phase 3 studies involving actual epilepsy patients who will be on this medication for years. The current valuation gap, while dramatic, may simply reflect the market's calculation of the execution risk inherent in taking any early-stage biotech asset through the regulatory gauntlet, rather than guaranteed success.
But Ovid is actively mitigating that classic binary risk through pipeline diversification, which moves them beyond the typical one-trick pony biotech risk profile. They are already rapidly moving forward with their KCC2 portfolio, specifically OV350 IV and OV471 oral.
This is a critical point that often gets lost in the noise. Can you elaborate on the significance of those KCC2 activators? How does that portfolio fundamentally change the risk equation?
Absolutely. The KCC2 activators are a distinct mechanism targeting resistant seizures by modulating the KCC2 cotransporter. This protein is essential for regulating chloride transport in the brain, and dysfunction in KCC2 is implicated in many forms of refractory epilepsy. OV350, the intravenous formulation, is expected to generate first-in-human data in Q4 of 2025, and OV4071, the oral version, is slated to enter the clinic in Q2 2026. This parallel development shows management is creating multiple distinct shots on goal. So if OV329 faces phase 2 setbacks, the company doesn't just fall apart because they have these next-generation assets targeting the root causes of seizure resistance. That diversification fundamentally reduces the binary risk that I think justifies your extreme caution on valuation.
That's a strong operational defense against fundamental risk. I'll grant you that. However, let's turn now to the biggest structural anchor, which has an immediate bearing on the stock price, and that is the authorized reverse stock split. I'm focused on the overwhelming negative sentiment this creates. Reverse splits, regardless of their necessity, are historically perceived as signs of fundamental weakness by the retail investor base, and the board authorized a highly aggressive ratio range, up to 1-for-40. This authorization doesn't signal confidence. It signals the gravity of the compliance situation with the NASDAQ $1 minimum bid rule, especially given that February 2026 deadline. That regulatory failsafe will likely trigger an immediate technical sell-off post-split due to institutional policies against fractional shares and just the inherent psychological stigma.
I frame the authorization and the vote itself differently. The proposal passed overwhelmingly, with 44.2 million votes for. This demonstrates that the institutional majority views the reverse split not as an admission of weakness, but as a necessary structural utility to preserve the listing and ensure future investability. A higher post-split price, potentially $40 or more depending on the ratio, moves the stock completely out of the penny stock category. This is strategically critical because it enables accumulation by larger institutional funds, mutual funds, and ETFs that have minimum price criteria for investment. This is a maneuver designed to act as a technical floor for future liquidity, not a fundamental ceiling that confirms failure.
That's an interesting point, though I would frame it differently. While I agree that the recent management change, Dr. Levin moving to executive chairman and Meg Alexander taking the CEO role, is a positive step towards stabilization, the very need for management to pursue such aggressive technical maneuvers confirms that market structure and the consequences of the recent financing are what currently dictate the stock price. The scientific opportunity is certainly there, but until that warrant overhang stabilizes or the board definitively acts on the split, the risk-reward profile is skewed toward extreme technical volatility, not fundamental gains.
The core focus for me remains resolutely fixed on the fundamentals. We have a potentially breakthrough scientific profile in epilepsy, demonstrated by the de-risked safety profile of OV329, backed by a fully funded runway that extends into 2028. This foundation has been validated by smart money participation in the pipe. The technical noise is structural, it's temporary, and I believe it offers a buying opportunity near cash value that astute institutional investors have already recognized.
And I reiterate the complexity of the present market environment. While the science is exciting and the KC2 portfolio adds considerable long-term value, the short to medium-term risk-reward profile is, in my view, currently distorted. The massive delta hedging pressure from the warrants and the looming necessity of managing NASDAQ compliance create volatility and suppress reliable price discovery. Fundamental investors might just need to wait for the hedging pressure to subside or the reverse split risk to dissipate before the true clinical thesis can fully translate into share price appreciation.
So we've spent our time today dissecting a classic dichotomy presented by the material, a highly successful clinical proposition battling against some very complex financial engineering and market microstructure.
Indeed, the ultimate decision for listeners really involves weighing these two powerful opposing forces, the undeniable potential of the science, represented by the OV329 data and that diversified pipeline, versus the immediate mathematical pressures stemming from the pipe structure and regulatory compliance deadlines.
Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.